All right, let's start the video with a question that could change your financial future. What would you rather prefer? $31,000 in monthly dividends or $8 million in total portfolio? Let me be very clear. These aren't just numbers I made up. They're the real potential outcomes of investing $100,000 in either SCHD or SCHG. Two ETFs, two completely different strategies, and two very different futures. If you chose the $31,000 monthly dividends, you're thinking like an income investor, someone who values consistent cash flow and financial stability. But if you pick the $8 million portfolio, you're thinking like a growth investor, focused on maximum wealth accumulation. Today, I'm going to show you exactly how each path unfolds. More importantly, which one might be right for you. And you might be surprised. The path that looks obvious at first isn't always the best choice for everyone. Let's start with the income investor approach. For this, we need to understand SCHD, the Schwab U.S. Dividend Equity ETF. With $66 billion under management, SCHD has become one of the most trusted names in dividend investing. And there's a good reason for that. It's a carefully engineered portfolio of America's elite dividend-paying companies. What I mean by elite? Well, SCHD holds companies like Coca-Cola, who's been paying dividends for over 100 years. Chevron, who kept increasing dividends even when oil prices crashed. PepsiCo, Microsoft, and Home Depot. These are companies that dominate their industries and share profits with investors through consistently growing dividends. Here's how they achieve this elite selection. By being incredibly picky about which companies make the cut. Out of thousands of dividend-paying stocks in the market, SCHD only selects about 100. Its filter is so strict that companies need at least 10 years of consistent dividend payments just to be considered. Then, they need to prove they have the financial strength to keep those dividends growing. Let me show you how powerful this approach is. Take Broadcom, SCHD's largest holding. While other tech companies were busy chasing growth, Broadcom built a business so strong it could increase dividends for 11 straight years. Or look at Merck and healthcare. They've turned life-saving medicines into a dividend-growing machine. These companies aren't just surviving. They're thriving and sharing that success with shareholders. What's even more impressive is how SCHD spreads your money across different sectors. About 20% goes into rock-solid financial institutions, 19% into innovative healthcare companies, and 16% into established tech leaders. You're essentially owning the best dividend payers from every corner of the American economy. And the results? They're nothing short of extraordinary. Over the past decade, while many dividend ETFs delivered average returns, SCHD doubled investors' money with a 108.44% total return. But here's the real kicker. It grew its dividend payments by 11.04% every year on average. That's not just beating inflation. It's building a growing stream of income that could eventually reach that $31,000 monthly figure we talked about. In just a moment, I'll show you the numbers. All this quality and potential comes at a cost of just 0.06% per year. That's just $6 for every $10,000 invested. Now, let me show you exactly how these incredible fundamentals translate into our $31,000 monthly income journey. Let's start with year one. At SCHD's current dividend yield of 3.57%, your $100,000 investment would generate about $3,610 in annual dividends. That's around $300 monthly. But here's where it gets interesting. Remember that 11.04% dividend growth rate I mentioned? This is where the magic starts happening. By year 5, your monthly dividend checks have nearly doubled. But more importantly, those companies you own through SCHD, they're getting stronger, raising prices, growing profits, and sending more cash your way. At the 10-year mark, something remarkable happens. Your initial $100,000 has grown to $310,310, and your dividend checks are now bigger than most people's car payments. This is when most investors start realizing the power of dividend growth investing. Year 20 is when life starts looking very different. Your portfolio crosses the $1 million mark, hitting $1.1 million. Those dividend checks, they're now larger than most people's mortgage payments. But the best part? These companies are still growing, still raising dividends, still compounding your wealth. And finally, at year 30, here's what you built. A dividend-generating machine paying you $31,000 every single month, backed by a $4.7 million portfolio. That's more than most executives make, coming like clockwork, whether the market is up, down, or sideways. Remember, these aren't just random projections. They're based on SCHD's actual track record of growing dividends by 11.04% annually. These are real companies, generating real cash flows, and sharing real profits with their shareholders. Think about what $31,000 monthly in dividend income really means. That's $372,000 per year that could fund a luxurious retirement, help put multiple grandchildren through college, support your family for generations, and give you the freedom to never worry about money again. And remember, this all started with just $100,000 invested in carefully selected dividend-growing companies through SCHD. Let me now show you something completely different, the growth investor approach. This is where SCHG, the Schwab U.S. Large Cap Growth ETF, comes in. And let me tell you, while SCHD's path to $31,000 monthly dividends is impressive, SCHG's growth story is nothing short of extraordinary. We're talking about turning that $100,000 into an $8.7 million portfolio. As usual, before I show you how SCHG achieves this kind of explosive growth and which path is best for you, you need to understand what makes this ETF so different from SCHD. With $37.15 billion under management, SCHG represents an entirely different investment philosophy. While SCHG focuses on steady dividend payers, SCHG hunts for companies that are reshaping our future, businesses that prefer reinvesting their profits for massive growth rather than paying dividends. Think about companies like Apple, Microsoft, Nvidia, and Amazon. These aren't just tech companies. They're innovation powerhouses that have transformed how we live, work, and play. And SCHG has captured their incredible growth journey. Looking at the portfolio breakdown, you can see this growth focus in action. Nearly 50% of the fund is invested in technology leaders, companies at the forefront of AI, cloud computing, and digital transformation. Another significant portion goes into consumer giants like Amazon and Tesla, who are revolutionizing entire industries. A key aspect of SCHG strategy is focusing on companies with sustainable competitive advantages. These aren't just one-hit wonders. They're businesses with wide economic moats that can protect their market position and continue growing for decades. Look at the results of this strategy. Over the past decade, SCHG delivered a staggering 330.26% return. That's more than tripling investors' money. And while its current dividend yield is just 0.39%, that's by design. These companies are reinvesting their profits to fuel even more growth, which is exactly what you want in a growth strategy. All this growth potential comes with an incredibly low expense ratio of 0.04%. Just $4 annually for every $10,000 invested. Here's exactly how this aggressive growth approach turns $100,000 into an $8.7 million portfolio. In year one, your $100,000 investment grows to $116,350. Sure, the dividends are minimal, about $35 monthly, but that's not why we're here. By year 5, while SCHD investors are focusing on their dividend checks, your SCHG portfolio has already grown significantly more in value. This is where growth investors start seeing their patience pay off. At the 10-year mark, your portfolio reaches $448,597. That's substantially more than SCHD's value at this point. But we're just getting started. At the 20-year mark, the power of growth really shows itself. your portfolio approaches $2 million, nearly double what SCHD would be worth. This is what happens when you invest in companies that are constantly reinvesting in their future. And finally, at year 30, here's your reward for focusing on growth, an $8.7 million portfolio. While it's not paying you $31,000 monthly like SCHD, you now have the flexibility to generate income however you choose or keep letting it grow. Of course, this journey isn't always smooth. Your $8.7 million portfolio might drop by millions during market crashes, but that's exactly when growth investors have historically made their biggest gains. So, that's the power of investing in innovation and growth, turning $100,000 into nearly $9 million over time. But remember, this path requires something different from you as an investor. Now that you've seen both paths, which path should you choose? Ask yourself these 3 questions. 1. What helps you sleep better at night? Steady monthly income or maximum long-term growth? 2. Can you stay invested during major market drops without panicking? 3. Do you need regular income or can you let your money grow untouched? The best choice isn't about which ETF makes more money. It's about which path aligns better with your financial goals and helps you sleep at night. Both paths can lead to financial freedom. They just take different routes to get there. But here's something most investors never consider. These paths aren't mutually exclusive. Some of the smartest investors I know actually combine both strategies. They use SCHD to generate reliable income while keeping a portion in SCHG for long-term growth. That's how smart investors think about wealth building. It's not always about choosing one path, but about choosing the right path for you. Or maybe combining paths to create your perfect journey to financial freedom. I'm Andrew. Thank you so much for being here. If you're interested in more strategies like this, you'll love my recent video about investing $100,000 in 3 best dividend stocks. The numbers in that video might surprise you even more than these did. Consider watching it, and I'll see you there.